This is the 5-minute Bank Nifty chart from December 19th. As you can see, the market creates this type of price action. Since price faced a strong rejection from this level and then dropped aggressively, many traders immediately assume the market has turned bearish. They enter a short trade right at the close of this large bearish candle. However, some traders avoid taking the trade because the stop loss is too large. Instead, they patiently wait for a pullback. A little later, price makes a small pullback and then starts moving lower again with another strong momentum candle. But there's one important detail. The candle does not close below the previous swing low. Then the very next candle continues moving down in the same direction. Seeing this, the remaining retail traders finally jump into short positions. But within a short time, the market takes out everyone's stop losses before dropping sharply in the original direction. If you're a day trader, you've probably experienced this exact situation many times, especially during the morning session. You lose your very first trade of the day, get stopped out, and that one loss affects your confidence and decision-making for the rest of the session. So what do you think is the real reason behind this? Was your trade entry actually wrong? Is this simply a trading psychology or mindset issue? Or is the real problem that you're not reading the price action correctly? In today's video, we're going to answer all of these questions step by step. So make sure you watch until the very end. Now let's get back to our topic. Price action is one of the most effective ways to trade because it keeps your focus on the one thing that matters the most: price. By understanding how price behaves, you can make better decisions about what the market is likely to do next. In this video, we're going to break down some of the most important price action signals, learn how to identify them on a chart, and understand the trader psychology behind each one. Signal number 1. Inside bar confirmation. Let's say the Nifty 50 has been trading in a range for quite some time. Suddenly, a strong bullish candle breaks above the resistance level and closes above it. When traders see this breakout, many beginners immediately start wondering, is this a real breakout, or is it just another trap designed to lure in retail traders? Because of that uncertainty, many traders wait for a retest before entering. But instead of pulling back, the market continues moving higher without giving any retest, leaving them watching from the sidelines. This is exactly where the inside bar confirmation setup can help. An inside bar setup consists of two candles. The first candle is called the mother candle. It's usually larger and defines the trading range. The second candle is the inside bar. It's smaller, and its entire high and low remain completely inside the range of the mother candle. Technically, the inside bar's high must stay below the mother candle's high, and its low must stay above the mother candle's low. Only then is it considered a valid inside bar. This pattern forms when the market pauses for a moment after a strong move. It's also known as a volatility contraction because price temporarily slows down before making its next move. When an inside bar appears immediately after a breakout, it often tells us that sellers tried to push the price back below the breakout level, but they failed. That failure is an important clue. It suggests that buyers are still in control of the market and continue to defend the breakout. Now let's talk about the entry. Once the inside bar has formed, wait for the next candle. If that candle closes above the high of the mother candle, it confirms that buyers have stepped back in with strength, and this can be used as a buy entry. For a more conservative trade, place your stop loss below the low of the mother candle. If you're willing to take more risk, signal number 2, double top and double bottom entry. The double top and double bottom are two of the most popular price action reversal patterns. They form the classic M and W shapes that traders use to identify potential trend reversals. When a double top appears on the chart, it tells us that price has failed to make a new higher high. This can happen for several reasons, such as weakening momentum or price running into a major higher timeframe resistance level. One of the safest ways to trade this pattern is to wait for the neckline to break. The problem is that if you enter immediately after the neckline breaks, your stop loss often becomes much larger than you'd like. That's why many experienced traders wait for price to pull back to the neckline after the breakout. If price rejects that level and shows a bearish rejection pattern, they use that as their entry signal. Signal 3. Shrinking candles. A shrinking candle setup occurs when the bodies of the candles become progressively smaller as price approaches an important supply or demand zone. When you see candle bodies shrinking near a key level, it's often a sign that the market is losing momentum. In other words, the buying or selling pressure is starting to weaken. For example, imagine price rallies from a lower level, reaches a higher level, gets rejected, and then moves lower. That rejection establishes a resistance level. Now, when price returns to that same resistance, pay close attention to the candle size. If each candle body becomes smaller than the previous one, it suggests that bullish momentum is fading and buyers are becoming less willing to buy at higher prices. As a result, profit-taking and selling pressure become more likely, increasing the probability of a bearish reversal. However, shrinking candle bodies alone are not enough. If those candles also develop long upper wicks, that's an even stronger sign that sellers are defending the higher prices and selling pressure is increasing. The signal becomes even more reliable if candle bodies are shrinking while trading volume is also decreasing. That's one of the clearest signs that momentum is fading. Finally, if a doji candlestick forms at those higher levels, it's often considered a strong bearish signal and can be used as an additional confirmation before entering a short trade. If you found this video helpful, don't forget to like the video and subscribe to the channel for more price action trading content.